Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today is Thursday, April 23, 2015. Inside the numbers tonight, we're going to talk about the SPY and the E-mini contract. We hit a number of 2015 today. It's very, very important, and I want to discuss it when we get to the charts. We'll do crude oil, had a nice update today. We'll talk about gold, a little update today. Interest rates in the bond market, and we'll wrap with the U.S. dollar, which I left off the inside the numbers tonight, but we're still going to talk about it anyway. So let's go over to the first chart, which is the SPY chart. And like I've been saying, we had a higher day today. Now, if you kind of tuned in after the market closed today and you see the S&P up 5 points, Dow up 20 points, doesn't sound like much, sounds like a flat day, nothing really going on. But here's the deal. Let's flip over to the E-mini because, that's where the numbers come from, right? We trade the SPY. Some people trade the E-mini. But most people don't have a futures account and trade the E-mini. So that's why I kind of talk about both. I know some do, some don't. So I try and give everybody a little bit of something. So let's go to where we were over the last day. Okay, so we're going to go to the intraday, and this includes the overnight session. So yesterday we close out, and this is last night, and all of a sudden we take a dip down, and this is like 4 o'clock in the morning. Okay, the market's down at 2087, which is pretty low compared to really where we are now, right? And remember when I was saying 2091 was a very important number? Well, here's 2091. You see here the this area here where this developed what's called a pennant formation. And a lot of times, not all the time, but a lot of times, a pennant formation will be after a move in one direction, the market will form a pennant, which is a series of inside bars from the last bar, which means the range of that candle is getting narrower and narrower. And then usually it breaks in the direction of the previous move, which was here. So down, sideways, down. Nothing much to it. It doesn't matter what it's called. The point is that that formation, the reason I brought it up was because it was formed at 2091. We broke down a little bit, and that's not unusual in the morning or after hours session, the overnight, the Globex session, very thin volume. And then we recaptured 91, and we kept going, and then we consolidated for a while, and then we went up. Now, I sent out an email earlier today around this time frame here, around 10:30, 11 o'clock in the morning. I said that the market was looking like we were gonna head for the 2103 to 5 area, and it looked like to me like we were going to bust through it and then start to achieve those higher numbers that we talked about. And that's exactly what happened. So sent the email out here. I know some of you caught it, right? Because I got some emails after the fact specifying what happened. So that's good news, and congrats to anybody that took the advice, took the trade. I'm not giving you advice, so scratch the word advice. I'm not giving you any advice. What I'm doing is I'm telling you what I see developing in the market, in the charts. I tell you what I'm doing sometimes, but I don't know you, so I can't tell you any particular investment advice. That's against the rules. But I can tell you what I'm doing, and I can tell you what I see, and there's nothing wrong with that. So what I saw was a market going higher. And what's important about this is when you go into this afternoon and you look at the high today was hit at 2114.50. 2114.50, okay? I've been giving you 2115, I've given you 2113.15, I've given you 2115 to 2120, and I know there's been a range there. But the point I want to make is if I'm right in the range, within a couple of points, let's say, I don't have to be picture perfect, I don't have to be pinpoint to the number, but if you can see what's happening here, you can see that the calculations that I'm doing are producing positive results, which means there's something to the calculations that's working. Doesn't work 100% of the time, but when it works, you need to pay attention. It's working, therefore, okay, it's a profitable money-making effort to be able to pinpoint numbers where the market's going to trade to, what's support and what resistance numbers are. There's money to be made when you know those numbers. And the folks that sent me the emails today understand that, okay? So what's next? Let's go to the bigger picture, and I'll go to the daily chart. And, what does tomorrow bring? Well, I don't really have an indication specifically for higher prices tomorrow, but there still is a 2135 out there. There's still the possibility that we're in the beginning stages of what's called a blow-off top. And the blow-off top can come into play if we're going to get a major top in 2015, which brings me to another topic. We may get a major top in 2015. We don't know until after the fact, okay? I'm not here forecasting a top until I see it developing, or you can see something that tells me a top is imminent. But I'm saying it's possible. And if we see a blow-off top here, that could mean another 100 points or so, maybe more, up on the S&P, right? That's 10 points in the spider, 100 points plus in the S&P E-mini, probably equates to about 1,000 points in the Dow. So those are the numbers we're talking about. Could be higher also. That would be that would be a blow-off top. If we saw something like that, that would, not only would it produce massive profits on the upside, but it would also produce one of those, once, twice in a decade shorting opportunities, okay? But we're not there. We'll get there when we get there, and believe me, I'll be able to identify it if we get there. Don't worry about it. I just wanted to point out the different flavors from a short-term perspective all the way out to a long-term perspective. Keep in mind, I'm looking at all that stuff all the time. But let's go back to today. So all in all, today had a good close. Okay, we reviewed the numbers from today. We saw where we went. There's higher prices coming. This wasn't the top today. We've got higher prices coming. It's just a matter of, how it gets there. Do we grind higher? Do we spike higher? Today was a very bullish indication because we hit the number I told you, or the range I told you we were going to hit. As soon as we catapulted over 2305 or 2105, we pretty much immediately, within a couple hours, went to 2115. And now we've pulled back, but there are higher prices coming. So I was pounding the table for a long time, buy pullbacks, buy pullbacks, buy pullbacks, higher prices coming. You see the titles of the videos, you see what I'm saying in the emails, you see what I'm talking about in the videos. This wasn't something I invented on Monday. This has always been culminating for months and months and months. I felt that 2015 was going to be a pretty wild year and a pretty bullish year for that matter, up until a certain point, and we're not there yet, so we don't need to talk about it. All right, so I think you got the point. The point is we're looking for higher prices. If we have lower prices, you know where the downsides are. They haven't changed. Right now, a big downside support level would be 2100 on the SP E-mini ES contract. And, that's because it's the big round number, 2100. It was the previous highs. We beat on it for a while. But anything bigger than that, I don't expect too much more downside. But if we do, again, pullbacks are meant to be bought right now. Let's go to gold. Gold had a little bit of an update today, and it's no wonder, right? It's still lower than my stop out point from where I got out under 1200, but I knew it was going to be up today because I told you that it was going to be up today because I was out of it yesterday. That's the way it works. It's still, it's a difficult endeavor here going on with gold. There should be higher prices. We're just not seeing it. We're seeing strange behavior. When I see strange and unusual behavior, I'm not interested in trying to play against the probabilities being reduced. That's what happened. The probabilities in my work were reduced when we went down instead of up. Therefore, I went out, and I'll wait for more clarity for the market to tell me what to do. I don't need to guess. I don't need to hope. This business isn't based on hope. It's based on mathematics, probabilities, risk management, and it's based on understanding where you're wrong and understanding where your target levels are. All those things put together equal a successful investor and a successful trader. If you're missing just one of those components, it could be detrimental to you. Let's go over to that's the bond market. Let's go over to crude oil. Crude oil had a nice update. It was up about 3 or 4% today. And here's the deal: we were up above this top trend line here, and what I said was if we can sustain up above this trend line, then we're probably going to go to 60 right now. I don't see anything really beyond that today. Could we go a little higher? Sure. Do I think we're going to get a sustained bullish rally up to 65 and 70 anytime soon? No, I don't see that coming. Of course it could, but I don't see it coming. That's not included in my work. But if something changes, I'll change with it. But right now, the top end move that I could see is right around the $60 area. And as long as we stay, and we did today close above this trend line, that's bullish behavior. This up move with a lot of sideways, consolidation going on is certainly bullish behavior. It's really kind of spooling, building up pressure to go higher. So how much higher do we go? Well, if you figure this up candle here, okay, would probably be replicated on this candle here, and you've got about halfway done now. So you've probably got another $2 on the upside, $2.50 on the upside. I'm just eyeballing it, folks. That's not scientific how I just gave you that calculation. I'm not getting out the calculator and I'm not getting out the measuring tool. I'm just telling you what I see with my eyeball, but I'm probably not off by more than 20 cents. Okay. The bond market. The bond market bounced back a little bit today, but I think there's lower prices coming, which means higher yields. And that brings me to something else I wanted to talk about. And we're waiting. We're waiting for the bond market to give us a decent enough pattern to trade. We don't have anything yet, but when one develops, it'll develop. It'll kick me in the butt, and it'll tell me what's happening, and then I'll pass it on to you. But what I thought is interesting is, remember, a couple of times I started to mention that if we're going to see higher interest rates with a higher stock market, you should get a good, solid, increased move out of the financial sector, because they'll rally on higher interest rates, because when their spread widens, so if they're loaning money at X and they're borrowing it at Y, okay, and the cost of money to borrow goes up. I'm sorry, the cost of money for a customer to borrow goes up, but the cost of money for the bank to borrow stays the same. That's immediate profit. And that's the reason that the banks, among higher interest rates, just become immediately more profitable on paper for that period of time, because of the loans that A, fluctuate, B, were just written at the higher rate, and a few other, issues that surround the loans and how they're calculated in terms of the profitability. So what happens is, when you see that spread widen, the banks should rally. And since we did have an up market today, the market has been bullish. We're seeing the financials sector suffer a little bit. We're seeing it struggle. So XLF is the ETF that tracks the major, global financial banks. Okay, the big integrated banks, the global banking system, Wall Street, all that stuff. Okay, now, I don't know about you, but this doesn't look good to me. This looks very bearish to me. I want to go to a bigger time frame, and I just want to take a look at it. If you kind of zoom out the lens and you want to look down, it's kind of like an astronaut looking down at Earth. Well, I guess really the monthly chart or yearly chart is like an astronaut looking down at Earth from outer space, but at least the weekly chart here is kind of looking down from an airplane. And what you see here is a big down move and some sideways consolidation. So for 1, 2, 3, 4, 5 weeks, this has been struggling. And that's bad news. So I'm not exactly convinced that we're going to see the blow off until I'm convinced that I see the financials and energy participate all together. In order to get the all-in, all systems go rally, you have to get all the sectors sucked in at the same time. It's very rare for there to be an all-out blow-off rally, getting the public sucked in because everybody's everybody's what's the word I'm looking for? Just joyful, and everybody's jubilant, and cover of magazines, all the bullish behavior, and they're laughing and all that stuff. Everybody's making money. That's fine, but you have to have all these sectors participate. So we've got to see energy, and it's starting to participate now, and you've got to see the financials participate. So I've got to see this turn around for me to be convinced that there's a real solid, big March higher coming. So if you look at the daily chart, where would the downside be if we did break down from here? Well, your level of support right now is probably going to be, for all intents and purposes, right around the 200 period moving average, this black line here. So between 2350 and 2370, let's call it, would be your support. So in this range. So let's even put, because let's monitor this one. No, I like this one. Let's monitor this one, and let's put it at 2350. I'm going to do some further work on that. But for now, we're going to put it at 2350, and we're going to monitor this one, and we're going to see. I would be a buyer of the XLF at 2350, barring some kind of breakdown in the global market system. But if we got down here on some kind of earnings announcements from some of the banks that were poor, and we had a bad couple of days in the financials, and XLF came down to that level, I would be a buyer, all things remaining the same in the rest of the market. So hopefully that's useful information. So I covered. You know what? I want to do GDX. I know I missed it last night. So GDX went with gold today a little bit, and we had a little bit of an update. Nice 2% update, about 40 cents. But you know what? It's the same story as gold. It's just not behaving and not characteristically behaving as it should. Therefore, while you may have upside to 21 and a half, the risk reward in holding this now is not in the favor of someone with a long position. It's really the risk. I'm not saying it's going down, but what I'm saying is that I wouldn't want to be a holder of it for fear that the whole gold trade is not going to turn out bullish. And because I don't have conviction on that, and I feel like the probabilities changed, I wouldn't be holding GDX. But that's me, and that's just my opinion. And that's what markets are made out of. It's made out of buyers and sellers, two sides, two opinions. And that's what makes markets, and that's fine. So that's the side I'm on. Okay. The dollar. Do we want to talk about the dollar? The dollar went down a little bit today. The dollar should have been bullish. We didn't see bullish behavior, but you know what? I'm holding a position in the dollar, but I don't mind because it's a long-term position for me. Even if we got down into this zone, I'll buy with three hands the dollar because we're going to see, 105 to 110 in the dollar on the next, well, maybe not just the next rally higher, but once the next rally higher gets going, you're going to start to see all those dollar bulls come back out of the closet and all the euro bears calling for parity and beyond, meaning the euro being 100 cents on the dollar to the dollar, and beyond, meaning the dollar going to 105 and the euro going below a dollar, which it hasn't been maybe since its inception, which is what, 15, 20 years ago, 15? I'm not sure exactly when, but it's been about 20 years maybe. So it's just interesting how this whole currency situation has flopped. The U.S. has the strongest currency in the world for the most part, and yet we're still probably just the best house in a bad neighborhood because all the global money printing that goes on from all the central banks around the world, from Japan to the Eurozone to the U.S. central banks, all they've done is flood the market with money, which, yes, folks, there will be the day of reckoning, but don't misunderstand. Stock prices today don't care about that story, okay? They really don't give a damn. They'll care when they decide to care. When the market starts going down and the sentiment shifts to bearish and the trend changes to bearish, all that stuff matters very, very much. Right now, it doesn't matter. So those of you hanging on the conspiracy stuff, you're right. I understand and I agree with you, but the stock market needs to be disconnected from that story for periods of time. When it's an uptrend and it's a bullish market, you need to disconnect that from the story. Nobody cares. Okay, they just care about higher stock prices. With that, we're going to give it a wrap tonight. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.